Hello, friends. Welcome to Nirmal Bang. I am Piyush Jain, and today we are going to be talking about the markets. We'll try and understand what's happening in the global markets, what are really institutions thinking about the Indian markets overall, how the sort of fund flows are looking to us right now, and more than that, how the June quarter results have been so far. To decode all of that, we definitely need an industry veteran. And let me now welcome our guest on the show, Mr. Sunil Subramanyam, MD and CEO of Sundaram Mutual Fund. Welcome to the show, sir.
Thank you.
So, sir, you've seen the sort of ups and downs of the market. And last year, perhaps, was a tough year for the market, for the economy, I think, for a lot of market pundits also, to really understand what's happening. This year looks like some nerves have been calmed down. We are largely now feeling that okay, the liquidity is not going anywhere in hurry. Yes, the flows are churning between geographies, but this looks like a much better world now.
Well, that's directly linked to the reduction of uncertainty on the way forward, right? Market doesn't like uncertainty. Last year was a very uncertain year in terms of how various participants looked at the market. And if you recollect at the late end of last year, people were actually saying that it's the time for fixed income and not for equities because there is so much uncertainty. Well, the year has shown that equity has given a good return, and is because of the fact that I think that the key story here is on the commitment of the Fed to fight inflation. I think how far the Fed would go, would they be tempted to ease up? And the market was, in fact, reading at some time that there could be rate cuts at this precise point in time that we are sitting. Whereas today, the reality is of a rate hike. But I think that's okay. At least the consistent thought process behind the Fed that we are here to fight inflation. And second aspect is the growth numbers are continuing to be strong, which means that Fed has wiggle room, because if the interest rate hike is hurting the economy, then there's some chance for worry. But it looks like, so far there has been no impact on the growth momentum because of the interest rate hikes, which means that Fed can continue inflation fighting, so to speak, without worrying about growth being impacted at this point. Of course, the key point which to remember is that ultimately inflation can be tamed in a demand driven economy like the US only by demand, controlling the demand. And I think that path is fairly clear, that there will be some degree of a slowdown and impact of the interest rates on the US economy. And I think the market, given that aspect of the clarity, I think is where the equity markets have reflected that in terms of that one. Second is the clarity around the Indian growth story, right? I don't think any of the events of the last 3 4 quarters has affected India's growth potential. We are hovering at a 6%, and I think that we are likely to continue at that rate without any problem, and any direction upwards can only help. So I think this is essentially a reinforcement of the fundamentals of the Indian economy and helps flows come into India relative to other geographies in the world.
Right. So then, actually, the next question becomes is that, and we have been a witness to really the opinions of the experts, as we were just highlighting. Between Jan and March, rate cuts were actually being sort of expected more, and now this is more about sort of some hikes, some status quo. But then the question is, where we are right now. What's your opinion right now? Where the flavor of the market right now is, both globally and in terms of domestically, like. Is it something sector specific, or is it largely sort of risk on trade? How you're reading it?
So if you see, the markets are essentially lead indicators of the future economic growth, right? So more than what happens currently, what going to happen in the future? And I think the answer is pretty clear, right? There is some degree of a slowdown. Now, a hard landing may have been ruled out because despite so much rate hikes, the US economy has not impacted. So a soft landing or a prolonged slowdown is in line. And in such a situation, you will see that the China, which is a major supplier to the Western world, if there is a slowdown in the Western world, you'll see a slowdown in China. In turn, China is a major importer of commodities. So if you see, then I would say that energy and commodities and metals and global cyclicals are going to be under pressure from a futures price perspective. And so, hence, I would expect whether it's in India or in overseas, these are the sectors which I would see as being under pressure. That's number one. Second is again from an India perspective, external oriented sectors where again the metals pack comes in, but you also look at IT and pharma as places where there could be challenges in terms of future growth expectations being tempered down. So I would say if you then take all those into factor, clearly from an India perspective, your focus has to be domestic because domestic growth story is we are pretty much dealing from international story because our share of exports of the world is less than 2%. So to that extent, our economy is largely going to be domestically driven, and the impetus for that is coming from partly from the government, partly from the PLI, partly from the rising capacity utilization. So I think India has got a kind of an island in this ocean of uncertainty, right? So I feel that so that gives a lot of clarity, especially to domestic fund managers, that keep your focus local, right, and allocate according to that. So I think you will see that domestic oriented sectors like capital goods, industrials, consumer discretionary are the areas where you will see increasing interest from domestic fund managers in deploying their capital. So I think that's going to be the story for the next I would say at least for a year or two until the world goes through this slowdown and then comes to recovery. So I would not rule out that in a 3 to 5 year time frame. But right now, if you look at it, I think the story is pretty clear. Is to go local, if I may use that word.
Absolutely, absolutely. So when you talk about discretionary, consumer discretion is something which I think a lot of viewers, a lot of investors, they actually have a great penchant for. But when we talk about discretionary, it's a very vast sector. In discretionary in particular, where perhaps you actually are seeing real value right now,
So I still
or
see
maybe moment,
value.
or maybe sort of earnings growth strength right now.
I see value in terms of growth potential still in the auto space and in the housing space. In the consumer durable space, I think it's the peak is the summer, right? And I think we are now past the summer for this year, so it's next summer that we need to look for. The refrigerators, air conditioners, and those kind of things are largely summer driven exercise. Some extent of the spike in those durables you can see during the Diwali time because people tend to
Right.
use Diwali bonuses to buy certain things. But I would still expect auto to be a major winner there. And I think the interest rate hikes have not proved a dampener for the housing related demand. In fact, contrary to earlier expectations where they thought that the affordable housing would lead the charge, it's actually the premium housing which is leading the charge. So I think that what the COVID has done is to basically make people upscale their the size of the apartment. They're willing to now go out of the city and live there, the quality of life. So I think to that extent I would say auto and housing would probably lead the discretionary space with specific festival season and summer season pockets for durables coming into play.
Does that also imply that we have to really pay close attention to the housing financiers, whether they are NBFCs or banks? That's something should be a good space also.
Housing finance, absolutely, because I think very few people go and buy a house in cash. Everybody leverages. Nobody, even the richest of the rich, always you know borrow some award. So I would say yes, it's a good wicket for housing finance companies, and to that extent. But the overall real estate sector also, I think, should benefit. If you see the use, the pickup in the unsold flats now getting sold and new
Yes.
launches and sales, I think there's good news there.
Right, and also one sector which has not been a favorite like since ages now, which is the infrastructure sector. In terms of like market cap, perhaps not as comparable to discretionary or any larger sectors, but infrastructure, is that something also where you're sort of expecting outperformance? That could be roads, highways, water, or any kind of infrastructure. Is that something also where there is still value?
See, it's a very it's a I would say, literally a Hobson's choice. Why do I say that? I'll tell you is that the way the infra plays out is that uh, the market anticipating the future tends to build up that sector based on a general economic news around capex, right? So what I would say is that the step one happens in a run up and a rally based on expected order book. Okay.
Absolutely. I agree
Step
with you.
two then is the actual order book reflecting into various companies. So between which company you expected to get to what company actually gets the order, there could be a lot of difference, right? So you will tend to make a lot of bets and then only some of them will pay off. The second step comes in terms of after they get the order, the execution of the order. So there again, there's a difference between different companies in terms of their skill of execution and capabilities, and for it to reflect in the EPS. So in the infra space, it's very interesting that two things, right? One is if you look at it from a PE ratio, right? A trailing PE is the worst thing to do because your past, absolutely doesn't reflect the future because it's extremely cyclical. But number two, price to book is probably a better bet than price to earnings because your order books is being priced in. So you need to be very careful on using the word valuation in infra because to make a stock market investor can make a lot of money off the infra pack well before infra ground story picks up. And actually, when the ground story picks up, you may find that the value has got eroded. So I would say it's like a roller coaster ride, it's not for the faint hearted.
Very nicely put, sir. And let me also ask you, and I've seen a trend here, like on this show itself, our viewers would be observing. There are so many manufacturing companies coming on the show. It's a sort of new India where we are seeing a lot of manufacturing IPOs, a lot of manufacturing companies making really sort of good gains, good gains from the perspective of business, from the perspective of how they are actually shaping up. As a large fund house, how are you taking a look at the manufacturing sector?
No, see, I think one of the things for the manufacturing sector is that the taxation for a new manufacturing company is only 17%, which is the one of the lowest in the world. So I think that's the reason that they are getting a straight away an 8% incremental profit because against a normal taxation of 25, they are at 17. So there's that for a new company setting up a new facility, that's straight away an 8% alpha there in the EPS. That's happening.
So,
Second thing is,
so I'm just taking liberty to jump in between. We were just a party to with a manufacturing company last week on this show where they were talking about the PLI and credit to them. They were investing and that entire investment basically is coming back to them due to PLI. So, like again, interesting benefits. Over to you again.
yeah, yeah, correct. So I was about to come to that. So the first benefit being the low taxation, second is the PLI, where up to 5% they get back. So you can take an 8% taxation benefit and a 5% cash benefit. You're talking about a 13%, you know, superior profit, for at least 5 years. So I think that that's the reason for the boost, and the government, I think, is very sensitive to the fact that employment generation can happen only from the small and medium scale
Yes,
sector in the
yes,
manufacturing space. So it's likely to continue to get a boost because the government has limited resources to push infrastructure on its own. It has got to enable infrastructure from the private sector, right? So to that extent, I think that it's a continuing story, and I think you'll see newer players coming in. And also, what happens is that when the government opens up the door to from the PLI perspective, a lot of spin-off industries also get benefit. It's not just that the particular PLI scheme, but a whole bunch. So I think that overall manufacturing is a very, very sustainable story for India because ultimately it's coming from a global move of a China plus many. People tend to say China plus one as if only India will get the benefit. But let's understand that it's China plus many, not China plus one. India has a good chance to grab it mainly because of the strength of our workforce, the population. There we stand to gain. Government policies are increasingly favorable. So I think things are set right in those terms. So I would say overall to have manufacturing as a key part of your portfolio is a very good thing to have. But it's important to diversify it across chemicals, pharmaceutical intermediaries, electronics, because all of them have got benefits. So don't put all your eggs in any one particular basket, but spread it across the manufacturing space.
Want to ask you on technology also. In particular, I picked up that sector because that sector has been sort of in the works last year. Last year, when it was being sold off, a similar pattern we saw in the US markets. They were being sold off, but actually, we saw a sharp recovery in the technology sector in the first half of this year, calendar year, there in US markets. For us, we are chugging along. Our technology sector basically is not seeing that great demand. What's your overall view? You alluded to one fact in the beginning of the conversation that right now, perhaps technology is something which is exposed to external uncertainty. So, our technology stocks, what's the view right now? Are the valuations still not looking that super attractive where we are?
So I think technology is still suffering the pangs of having got a huge boost during COVID, where they were expected to be it was another Y2K moment they spoke about, right? And the valuations went from over the last decade, technology had become a safety bet, consistent
Yes.
earnings expected, rupee depreciation consistently happening, and India having a critical mass in terms of good quality companies. So it was a very safe sector, and foreigners also loved it because of that. But during COVID, there was a sudden transformation. Everybody chased technology like there was no tomorrow, and those valuations expanded a lot. So today, what that sector is still suffering is just a resetting of those valuations to a normal level. So, because it was just a market hawa that took it up. So the point is that uh, that has to come down to normal levels, and I still feel that that's not happened, because it was happening until the rally happened some months ago, and again it took out. So to me, I think, see, it's a good bet as a safety play according to me. But today I feel that the price for that safety is a little too rich, right? So it's something that you keep accumulating over a period of time, but you got to
Time
take it
correction.
you got to keep buying it on dips, because
Mm,
I still feel that there is still some amount of what do you call, helium, if I may say, in the valuations, which has to dissipate. So but at the same time, stock specific, there could be gains and winners, because in a slowdown, because technology happens to be a big expense on part of a buying company, in a slowdown there's always change of leadership and change of market share, one company going outbidding the other. So you can still pick winners within the space. But buy the space as a whole, I would say buy it to the extent that safety is requires it in your portfolio, and don't think that it's going to be your money back or whatever, right?
sure. Let's now touch upon the mid caps here. Flexi mid cap fund again, basically, sort of Sundaram House brought upon clearly an indication also basically that that particular entire pocket was really loved by the retail investors. A lot of sort of chasing of the money happened first in large caps, then mid caps. There was a brief period of time this year that where everything was looking so easy. I wanted to actually take a view where you're thinking right now in terms of valuation between large caps, mid caps, small caps. How's the market position in equities?
See, what's happened today is that the earnings projection for all the three are interestingly hovering at the same levels, which is a very unusual situation. Okay. And hence, from that point of view, the valuations of mid and small caps are looking a bit rich. Okay. But I would not solely worried about that, because in a growth business cycle, the market always underestimates the growth potential of mid and small cap companies, right? Why do I say that? Is because their fall and rise in terms of EPS is never linear, because they have very high fixed costs, right? The cost of interests are much higher for a mid and small cap compared to a large cap company. The amount of interest that they have to pay out is significantly higher. The depreciation component of their business is also higher. So they tend to have a situation where even a 10% drop in sales can lead to a 25-30% drop in EPS, but a 10% rise in sales can do the same. But market hesitates to go into such a territory of over projection, and so market tends to go linear, and that's where the profit making potential of mid and small cap comes through. The key deliverable there, key what you need to have, is a good economic climate for the domestic industries, right? The only then that mid cap companies do get a kind of a top line growth. So I think when that happens, the actual earnings always beats the consensus estimates. And that's how mid and small caps in an up cycle tend to deliver far better returns than do large caps. So I think from an Indian economy perspective, we are poised on the post-COVID recovery. We are just the beginning of a bull economic run. And I think that augurs well that despite what today appears as slightly rich valuations, I still feel mid and small caps will ultimately deliver better value to an investor, provided a he has the staying power to stay for a 5 year period.
Most
Provided
important.
B, he allocates it through the cycle through SIPs or STPs, right? And the three is provided he doesn't look at the NAVs of his fund in the interim. Okay, I think
So that's the hardest. I can say that that's the hardest.
so. I think if they do that, I still feel that there will be value to them coming from, and it's important that it's diversified. It's important because different mid cap sectors deliver at different times, and and like I said, an infra mid cap play would deliver at a different time. A pharma mid cap would deliver differently. Consumer discretionary would deliver. So you need to have it diversified across sectors. That's critical, because then only you will be able to minimize the risk of the portfolio.
I want to ask now one question to you on the fixed income side. Um, at the start of the year, I think it was a time to really feel intelligent that we know that now basically is the time to sort of bonds to start rallying because interest rates बहुत ऊपर चले गए. They have risen a lot. Now cuts are going to happen, right? And now when we're sitting in the mid time of the year, the question is how are the fixed income funds now actually really going to perform? Perhaps which type of funds should I see? I think if we can get some of those answers for our viewers, perhaps that would be helpful.
So first is that you know uh, from a fixed income perspective, right? There are two separate markets at play. There is a core lending market from the bank, which takes money from the capital markets and lends it on to borrowers. And then there's the market where issuers come and issue papers, right? And government is also an issuer there. Why I point out is that a lot of the growth in the fixed income is going to happen in the non-capital market part of the market. That is banks lending to infra play. Very few of those companies are going to be able to tap the capital debt capital markets and take money from a mutual fund, right? So while you are looking at one interest rate scenario on the ground level, there could be something very different in play in the debt capital market. That's number one. Number two, in the debt capital markets is very sensitive to the Reserve Bank's actions. And today we are in a world which is a highly connected world. The Reserve Bank cannot afford to take an interest rate call or a liquidity and monetary call on India without looking at what the Fed and the ECB are doing. What is
Hmm.
the reason for this? Because interest rate policy and monetary policy are closely interlinked not just with domestic lending rates but with the currency, right? So like you mentioned, right, from that time to now, what changed? Nothing much changed in India, but what changed is the world's view of will the Fed cut or is the Fed going to continue to hike. So there the fundamental view. So if the Fed is going to continue to hike, can the RBI be ignoring that particular aspect? No way, because the currency has to be managed, right? So hence you could see rate hikes from the RBI in order to just manage the currency, right? Could. So it depends on, RBI has a monetary policy tool and interest rate tool. RBI also has a particular target currency rate in mind, which neither you nor I know up to where they are comfortable. So in that sense, right, your fixed income today is a subject to the actions of the Fed and how the US economy does. So our Indian interest rate scenario is driven by a US economic growth outlook, right? To that extent, then what how do we then go to play the domestic scenario? The thing there is that the possibility that rates can go higher, and the higher they go, then the sharper the likely fall, is complicated by the fact that at the same time the monsoon has proved to be a negative surprise in India, right? Compared to a few months ago where everybody was saying good monsoon, today it's clearly below average and it's not raining where we need, and it's showing its spillover in terms of food prices and vegetable prices all spiking up. So RBI's hands are tied, that even if it wants to cut interest rates, inflation is not helping them. Though you can argue that RBI interest rate policy will not affect the price of vegetables, but RBI can't be seen to be going easy on interest rates when inflation is rising. So RBI has a very tough job to do. One hand, look over its shoulder at America and the currency, and second, to look at local inflation. So to
So
that
I'm tempted. I'm tempted to now ask you. Like I'm just jumping in because when I heard you, I started thinking. Does it imply that over the next 4 5 months, some money basically is going to start moving back from fixed income funds to sort of equity funds? Is that also a live possibility?
I do think so, because what had happened earlier in the year was a lot of people shifted from equity to fixed income, thinking, a lot of people thought
Yeah,
that this is
that,
the year of fixed income,
this is
and
easy way. Yeah.
they've actually lost opportunity, lost money because of that. So I would see some amount of retracing by hot button investors. That, yes, I agree with you. But coming back to the point, so where should a fixed income investor look at? I would say he has to keep his medium to short duration in mind, right? Probably 2.5 to 3 years duration is probably the ideal place to go. Not to take an extreme view in terms of going further down in the duration curve, because right now that would mean that you would tend to have an accrual oriented portfolio, right, where the coupon would give him some amount of FD plus kind of a returns, and you would not get hurt too much with the volatility in the interest rates. I would say stay in the short to medium duration. 2.5 to 3 years would be the ideal.
Right. And our last question from the Sundaram house, with so many of funds across all the categories we just talked about, a couple of them introduced recently. Let's talk about the last question as a sort of roundup of everything. What is your own sort of expectations for the earnings growth from the market for this financial year so far?
So I
And
think that for the current year, from the overall broader market, I would expect an 18% earnings growth.
okay, and that actually is pretty strong. That's the expectation, and I think everybody should be very happy and go home. Okay, sir. So, as always, it has been an honor to have you on the show and get all the insights on the market.
Thank you. Thanks.
With that, dear viewers, it's a wrap on the show. Hope you enjoyed the insights.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.